right, welcome everybody. Appreciate people tuning in and appreciate our guests showing up today to give us some education. Today we have the group from Invest on Main Street, and our presenter will be Patrick Grimes. Patrick, we appreciate your support of Left Field, and thank you for coming on today to try to educate the community a little bit about your area. Thank you.
I've been following Left Field for a while now, and we've
Yes.
had a number of conversations. I'm glad that we could finally make a lunch and learn happen.
There you go. Yeah, we appreciate that too. So we'll turn it over to you. Feel free to dive in. If anybody has any questions along the way, please put those in the Q&A and we'll answer them as we get to them. So, but outside of that, Patrick, all yours.
All right. And if you're eating lunch during this lunch and learn, good for you. For right now, it's 6 in the morning and I haven't even eaten breakfast yet. So I'm in Hawaii. And so we're spending a couple months here over the summer. We lived here for a while during COVID, so it's kind of like our home away from home. My name is Patrick Grimes. I'm the CEO and founder of Passive Investing Mastery. We also have Invest on Main Street. I did my first deal a long time ago, so I've seen some ups and downs, and that's why we want to talk about the upside of downturns and recessionary investing strategies. I was raised up in the mountains, consider myself a mountain boy, and picked up an affinity for being a geek early on. Stuck true to the path, did machine design, automation, and robotics in college. That's me actually on a manufacturing floor of a custom automation design company that I worked for. And just to the left of me is a flu test machine that later became a COVID diagnostics test machine. And then in the upper left there, it's actually a 4 parallel line robotic assembly for the Tesla motor, the Model S rotating part of the motor. Pretty cool stuff. And then behind my head is a Lockheed satellite solar cell assembly, robotic assembly. So lots of cool stuff. And the first automation house that I worked for, I call them automation houses. The owner, the founder, one of the brilliant guys, still invests with me today. He told me that his only regret was that he didn't invest more sooner into real estate, not invest more and build a bigger high-tech company, but go into real estate. And he got me early because there was just so many ebbs and flows in his life that he saw that the real estate portfolio he had built is what would truly provide him the security for himself and his family as he went later in life. And so I kind of latched onto that and being eager, instead of going and buying more company stock or day trading, I used my bonuses and saved up, and I invested what I thought was the highest returning deal that would get me to my goals the fastest. Unfortunately, this was 2006 and 2007. And while at the time, everybody thought, can't go wrong in real estate's never going to go down. It did. And I lost it all. I went into pre-development, which isn't even development. It's just land. And that's a picture of it on the bottom right side corner of the screen there, where we're just trying to get plots and entitlements. And then later the plan is to develop. So the bridge between cash flow and something that pays for itself is very long. And you hope on the other side of your project that you'll have something that you can build on, that you have a building that you can rent or sell. And you hope that during that whole time, the market just doesn't fall apart on you. And it did fall apart on me, right in the middle of it. And what went wrong was 2008 and 10. And while this is not likely to happen in the exact way again, which we'll talk about, it's the theme of this is what are things to consider for recessions and strategies. What I did incorrectly as an investor that I could learn from in the future was I was speculating. Turns out I didn't know the difference between speculating and investing. And that meant I wasn't buying for cash flow, and I wasn't buying things with immediate comparables. I was buying things and speculating and hoping that if something was created, then there would be a market, a rent, and a building that could be sold. I also was trying to be very aggressive. I purchased things in my own name, and I got loans in my own name. And that allowed me, just like how you're probably doing with the home that you live in, that allowed me to get better debt. Because if the bank could collateralize the loan with me and all of my other assets, then they're going to give me, just like you do with your own home. But you get to live in your own home and you have a day job paying for the bills of your own home. In this particular case, it's an investment, and there was no income to pay for that investment. I had highly leveraged it. I had 90% loan to value. That seems crazy today, but back then, that's what people were doing. And it was a balloon payment. Again, seems crazy today, but back then that was the norm. And so I had a short fuse. These are all important things because it's a little bit foreshadowing some things we'll talk about in a minute. Also, I was all in one investment, and I was not the tortoise. I was the hare. I was doing my best to try and get eager and get rich and get out and make as much money as fast as I can. I learned a lot from all that, and I pivoted moving forward. Afterwards, I kind of drug myself through the coals and finally got out of it. I went through foreclosure and had to pay debt forgiveness, and dove back into my high-tech career, got a master's in engineering and an MBA. That started doing very well again, and I still had that voice, what are you going to do? So then I pivoted from there into single family existing construction. I started buying things that are properties in recession resilient markets. I learned about those, and from that, I was able to be successful. I was able to be successful at building a single family portfolio, but I was moonlighting it. I was doing it all myself. I was the DIY investor, kind of glamorized on the TV. And unfortunately, while it seems fun and romantic to buy a fixer-upper and renovate it and refi out and do it again and again, if you're a professional like I was, successful, doing a very demanding job that is high income earning, and then you go be a landlord or be a flipper or whatever it is you want to do, that's another job, and it's exhausting. And so I was moonlighting that. Not only was I moonlighting it, but I was struggling to make time for my soon-to-be wife. So when she stepped on the scene, as we got serious, she was there for my very last single family closing, and that was it. I hung up my hat. I said, we got to find something new. We traded the single family in for multifamily, larger multifamily, single family, 3-bedroom, 2-bath. My first multifamily is 86 units. So really made a big jump. Founded Invest on Main Street, a private equity firm that allows us to syndicate, pool investors' capital together to take down those larger assets. I had a pretty significant network of high-tech professionals and executives and entrepreneurs that I was able to pull capital from, all accredited investors with 100,000 minimums. We took down quite a bit of a portfolio. Since then, I've become a little bit of a thought leader in the space. I write Forbes. I got half a dozen articles on Forbes. Highly recommend you check out our website. Lots of really good content, specifically on some of these topics today. I'm a best-selling author. I speak on stages monthly. Actually, if anybody's in San Francisco, I'll be speaking at Infin on the 5th, coming up here. So I'll be happy to meet you and see you there. So why diversify? Specifically within the space of alternative investing, we are looking for investments which are other than the traditional path to the American dream. That's dump everything you got into your employer-sponsored 401k or IRA, and then maybe get a financial planner. And if you get a financial planner and you graduate there, they're just going to put you more index funds and more things similar to the traditional path, all of which is buying paper. It's buying the cyclic nature of the market and sentiment driven. There's no tangible real asset. And so we talk about alternative investments. It's alternative to your pensions, your 401ks, your IRAs. And if you look at how do you allocate that? How do the wealthy allocate that? How do you get free of waking up in the morning and watching the news and the fear mongering and fearing interest rates and recessions and all that? You got to get into alternative investments. The middle class, as you can see here, about 8%. The upper income have 25. Ultra wealthy have 49 in alternative investments. So if you want to start stepping it up and and investing like the wealthy, you got to get 25 to 50% of your assets in alternative investments. Those are harder to find. Business equities, real estate, things that don't all ride the same cyclic market as the stock market. If you look at Tiger 21, it's a similar allocation. And so this is a really good data point because you're looking at 27% in real estate, 26% in private equity. And again, normal stocks, cash, commodities, fixed income, hedge funds, public equities, these are all half, again, of the wealthy. So you got to start really leveling up. I'm about diversification. So we're about providing those opportunities. Not only in just real estate, as you can see here, we have about over $500 million in active acquisitions. We have 4,000, I think almost 5,000 multifamily units, 7 states. We also have diversified energy portfolios. We have a recessionary acquisitions fund and some debt stuff coming up as well, and some alternative investments which are completely off the grid here. But you can see we're traditionally focused in the recession resilient markets, southeastern states, and a little bit in the Midwest, landlord friendly and tax advantaged. So that is us saying what we do and doing what we say in the recession resilient space. So now that we've said all that, you kind of understand the first wave of the downturn that I experienced, kind of how my life journey came out of that. And we talked about what went wrong in 2008. What did we learn from that? What did I learn from that coming out of 2008? And then I pivoted to a DIY real estate investor. And then I said, well, look, let's build a portfolio moving forward. So over the last decade, what were the lessons learned that allowed us to build a recession resilient portfolio that will ride out this recession today? And then after we go through that, we're going to talk about recession issues today, what's different, and then we'll talk about what's required to win by investing from today forward, because it's very different recession. So looking back, building a recession resistant portfolio, as I said before, is existing construction. I do not believe in development. I don't want to create something out of nothing. Life's too short to be tossing and turning in bed, to be gambling big and then just rolling the dice. I'd rather be not speculating, but doing systematic investments in cash flowing or quickly cash flowing assets that I know can ride out a downturn and I won't lose it all again in the middle of a recession. I want to do low leverage. I don't want to do this, even 70, 80, or 90% loan to value. I want to get low enough leverage, which means I put high down payments up such that I know that I'm cash flowing. So much so that if their vacancies fall, like to where levels they have in past recessions, I still cash flow. In other words, my break-even occupancy is strong enough to sustain a recessionary occupancy or recessionary vacancy sort of situation. And I want that debt to not only be low leverage, but I want to be able to control the interest rate on that debt. And that's a lot of what we're seeing here today, right? People talking about interest rates climbing. A lot of people didn't expect that. Like we have a beautiful sunrise happening here in Oahu, Waikiki Beach behind me. So I'm enjoying that in my own view of my own video. But we want that break-even occupancy, the ability to cash flow. We want that ability to cash flow to be able to cash flow even when vacancies are high from recessions. And we still want to be able to cash flow if the interest rates rise. So that means you got to get debt. You got to get a debt on your product with either a fixed interest rate and long-term so that it won't change during your ownership, or what a lot of people did is get variable interest rate, which means it does climb. Now, if that happens, then you could go completely under. And there are properties with capital calls having a very hard time today, thankfully not in our portfolio, that are struggling with those rising interest rates. Now, some of the operators that, like us, that in the cases that we did use variable debt, we bought a rate cap, an interest rate cap. That means the interest rates can climb to 2, 3, 4, 5, maybe 6. And then at that point, we said they're still going to climb, but we're buying a cap. And that insurance company that bought us that cap, they're going to pay for that spread, anything above that. So now you need to make sure even once you reach that cap, maybe it consumes your income to reach that cap, but you need to make sure that once you reach that cap, you're still cash flowing. on your property. It means low enough leverage so you can withstand vacancies and you can withstand rising interest rates. And then you don't want to just buy something and hope and hold. You want to buy something that you can get in there, get your elbows dirty and improve. And that's why the switch from single family to larger multi for us was so critical, because we can buy something, we can see the nearby comparables, we can see that they have outdated renovations, we can see that the pool needs to be fixed up, and then we can look over at the nearby properties and say, look, this is what they're renting for after these improvements. We can create value by going to work on it. So even though we have low leverage on day one, and we have this recession resilience on day one, cash flow, we want to be able to quickly create more value. That further hedges against the downturn, because not only are we feel comfortable going in, but we have even more equity as you step in. Makes it harder to do deals, the way I'm describing, and it does lower your return. Not only because you're putting so much capital down and you're buying rate caps, but we're also putting operating reserves in. Operating reserves for us means 6 to 8 months of expenses. What does that mean? That means no rent comes in. You got all of a sudden, one day, all your tenants go broke. You can pay and float the property for 6 to 8 months. Now, why is that important? Well, that's important because we just saw it. We'll talk about it right now that, people stopped paying rents right after COVID, right? That's an economic disaster. Well, there's also natural disasters. So when you have a natural disaster, you need insurance. That's the other item here. You just don't need insurance, but you need replacement cost insurance. And if you have replacement cost insurance, which I'll show you some examples in the subsequent slides, that has allowed it to be a win. If there's a fire or a flood, whatever it is, oftentimes we can rebuild a new building, we can rebuild it to our upgraded standards, and we can have a better property on the other side. But you got to get to the other side, which means the insurance company is not going to front the cash. If you have a flood, you've got to float the capital and then get reimbursed on the other side. That requires operating reserves. That means the building could be great. You could have a very healthy building, and you could have a great insurance policy. You could be cash flowing and everything could be fine, but a natural disaster could come. And if you don't have the operating reserves, you have to sell immediately or recapitalize immediately. And that's one of the sources of great buildings with great deals that we find people just become distressed because of a natural disaster. So 6 to 8 months of operating reserves gives you plenty of time to recover from a financial natural disaster, and the ability for you to write out an insurance claim and then get reimbursed on the other side. Now, we also go for recession resilient markets, as we talked about before. We work in workforce housing. I don't work on the top 1% luxury stuff. Those are the first to take a hit in downturns. And we don't do the big boom markets like the Phoenixes, where those took 12 to 14 years to recover. We're looking for places like the Houstons, right, that steadily grew, and then 09 and 10 leveled off and then started went up again. Now, all of this is what helped us build a recession resilient portfolio that led to today. Excuse me. So for an example, we found this asset. This wasn't an asset. There's a couple case studies here. This wasn't something that was on the market, was proliferately available, had 1,000 offers on it. This was something where the owners had bought this thing and then done nothing to it. They had just let this go. It was a Jacksonville, Florida property, which typically Florida tends to be a little more recession affected. Well, in Jacksonville, you have diversification away from just tourism and hospitality. You have logistics, you have military, you have business, and it's really close to the north side of the state, lots of trade, one of the biggest ports on the East Coast. So this is a very stabilized, much more recession resilient niche within Florida. But the owner had become ill and he needed to exit. We heard about this off market actually from a lender, and a lending broker let us know. We swooped in there, purchased it. We had the family office put up all the capital to take it down. And then we backfilled it with the syndication. Not a single one of the units were renovated. So we got a great deal, by buying something from a distressed operator, really good asset from a distressed operator, not a distressed asset, solid cash flowing asset, got a good basis with lots of improvement capability, almost 300 units, none of them touched, all of them identical, old school, brown cabinets and Formica countertops, and just is about as typical as it gets, what your grandma's apartment would look like. And we bought in there. We immediately started on the business plan. Within 9 or 10 months, it had appreciated dramatically. We had forced the appreciation. We had captured some gains on the front end, and we were able to sell it at a $10 million profit in about 10 months. And so we bought it for $27 million, sold it for $37 million. This asset right here is in Houston. And I remember when I got the call, because I was actually living right here during that time, during COVID. My wife and I picked up out of California, moved here to Waikiki. And I red-eyed out, landed in Houston, met my partners out there. This operator had an aggregate number of issues. This is Westbury Reserve, similar to what all the items I was talking about. He had shorter term debt. He had a big called bad debt from his tenants, meaning the residents were not paying. He had not kept up the property. He didn't have reserves, and he was having flooding issues and pest issues. So he was draining his operating reserves just to pay his bills, because people quit paying because he wasn't taking care of the property, which created a spiral. So allowed us to move very quickly. He didn't want to have it. He had investors, so he didn't want to go on the market and kind of have this embarrassing situation. So we moved quickly. We locked it up. We did our due diligence. We found a ream of paper stack thick of unanswered maintenance requests. And so we were able to get in there and make it a better, improved living experience, safer, and renovate those units and make it healthier for the residents, while buying at a great basis, putting long-term debt on it, and increasing the income and producing value. This asset was similar to the issue I was saying without the insurance policy. So this guy wasn't well capitalized. He didn't have the reserves. When we came into this one, there was an entire building, one of these with beautiful buildings, right? An entire performing cash flowing asset, an entire building had just burnt to the pad. He didn't have the insurance policies necessary or the operating reserves necessary to carry the property forward. The hidden income put him in a tough spot. It gave us the ability to swoop in and manage this guy, or take this guy over and save the day for him, provide the source of relief for him. But now we get to own the asset, and we have 6 to 8 months of reserves, replacement cost insurance, low leverage. In this place, we had floating debt with a fixed interest rate. So at a much more recession resilient Atlanta location, but with a foundation that could ride out those recessions and or natural disasters. This was a similar thing where there was a fire on the property, and the landlord only got about halfway through trying to rebuild one of the buildings, and he was just like, look, I ran out of money, I need out. Perfect for us, right? We were able to jump in there, and we acquired that over almost 300 units, 320 units, not a single one renovated. He just was trying to survive, trying to get this building rebuilt, ran out of money. We're able to jump in there and pounce. Great asset. We're working on it right now in San Antonio. So that's some examples. And in today's market, that's some examples of how we created deals to ride, or created our portfolio today to ride out recessions. And that's the first half of this presentation. That kind of brings us to this halftime. And then what we're going to do from here is I'm going to pivot to what are the challenges today, because although we created and we followed those principles that I mentioned before in order to find the right kind of properties and structure them in the right way with the right kind of debt products in order to ride out recessions, today things are different. In fact, today things are different from past recessions. And economists and historians, all we can do is really look to the past. We can learn about how things, and we can build and we can conduct our lives in a way such that they're intelligent based off of the past. Well, we're going to have to be a little bit of a historian and an economist at this time, because This time, the things are a little bit different that are happening. It's not all the same as it has been in the past. And so in today's market, what we see different than 2008 and 9, right, is interest rates are going up. It means valuations are going down, right? So that makes it tough for a value add investor that's hoping for long-term rent growth, and that rent growth to attribute to valuations going up over a period of time. But if rents are, and then compounding to that, we have inflation. And with inflation increasing, that actually does grow rents, which is great. I actually have a whole article in Forbes about how income generating real estate in specific ways, structured specific ways, are the best hedge against inflation. Patrick Grimes' Forbes Inflation. You can check that out. But although inflation grows rents, which is great, it also grows our maintenance costs. It also grows our renovation costs and our materials and labor for those constructions. So what we're trying to do is spend our CapEx budgets to improve and renovate, to grow our rents, but at the same time, our cost for that CapEx is increasing, right? Interest rates are growing, which decreases the valuation. That wasn't the case in past recession, all at the same time. And we've seen a ton of natural disasters. I have a property that I've had 2 500-year floods at, and I've owned it for like 3 or 4 years now. So there are many, many more natural disasters happening, and what are traditionally the more advantageous locations to invest in the southeastern states and Texas, where it's landlord friendly, recession resilient, tax advantaged, influx of people, is in those areas right now where we're actually seeing insurance premiums. We're getting quotes back. Whole carriers are leaving. They're leaving the markets entirely. They've been hit, rocked so hard for so many years. They're just packing up and moving. New ones are coming in. We're getting quotes for almost double what we have had in the past. We're fighting it back and bringing it down, but interest rates are one of the highest expenses on your insurance premiums are one of the highest expenses on your bottom line. And so that's been tough for us. So that's partially inflation, and it's partially the fact, whether or not you believe in global warming, that natural disasters are on the rise, that these tornadoes and these hurricanes and these things are happening, these floods are happening. Coming out of COVID, a combination of natural disasters and coming out of COVID, which strained the governments in these areas, there's a bunch of tax reform going on. And we have seen normally in places like Texas, we're fighting taxes every year, but they've been more aggressive recently. So in addition to inflationary measures of our costs going up for materials and labor maintenance, we also have these challenges with insurance premiums, and we're still fighting our property taxes. Insurance premium, property taxes are the biggest line items. And so it's not all markets, but most markets right now, these institutions are playing catch up, both the government and the insurance. Now, what I mentioned before is, while all of this is going on, you have interest rates rising, right? And if you didn't get fixed interest rates, it doesn't matter to you. We have most of our portfolios fixed interest rates, and we're just like, we're fine. But if you got a variable interest rate, then you better hope to bought a cap and have a hedge, an insurance, and that's a hedge that you don't have to pay any more growth beyond that cap. And you better have bought that cap low enough to be able to cash flow through this time. And what's interesting is we're hearing all the time now that that's not the case. In fact, Bloomberg just put out an article saying there's a $1 trillion between now and the beginning of 2025 in bank debt coming due at higher interest rates, which means the property values were hit. Right? The property valuations were hit because interest rates went up. Also, these properties are valued on income. Now, rents hopefully have gone up, and inflation helps that, but the income is going to be hit by the greater inflated costs, by the greater inflated insurance premiums, potentially by greater taxes. So the income strain, valuations are shifting, which is what we call the cap rate. And hopefully these individuals bought a rate cap. When they bought it, they can even cash flow it, and they can even make it to the end of their loan term. And so I think it's right now it's a very unique time. There really hasn't been a time like this in my lifetime. And looking back, I don't see one quite like this. Even the most conservative operators, and we're one of them, that have been humbled and beat down before, I'm going to be honest, we're struggling. we're succeeding. We're fighting through it, but we're struggling to stay on our timeline because there's just a lot of pieces at play. And we have reserves, we have fixed or capped interest rates, we have great individuals on staff. But right now, we are 100% hands-on. Now, your capital is preserved because we have all these fortifications, but it's slowing us down, especially coming out of COVID, when the entire government was pretty much propped up by the country was pretty much propped up by these COVID relief checks, right? And very much so in apartment communities across America. And when that rental assistance ended, the rent payments did not resume. And we're here on what is the tail end of the reckoning. The reckoning was when the rental assistance ended and certain supplement checks came in and then ended. And we got a $100,000 check for just one portfolio in the Midwest, just in rent. That's a lot of rent not being paid and supplements coming in. Well, what happened was a lot of those residents hadn't been paying. All of a sudden, they were told they had to pay. They didn't pay. The ones that did, good for them. But the ones that didn't never got evicted. Why is that? Because they had an eviction ban. So the courts were already backed up. And then every apartment owner in America asked their residents, hey, are you going to start paying? Most of them said not. So every owner pretty much filed, dozens, if not hundreds, of evictions all at once. So delinquencies skyrocketed. The residents that were paying stopped because they saw that nobody else that was paying, and they weren't getting evicted. And the eviction courts backed up. And in places even like Texas, where it took 1 or 2 weeks for us to get somebody out, now it's like 2 to 4 months. And in places like Atlanta, I just was on a similar. I was like 2 to 4 months. I was actually just 4 months. I was on a call with a family office who's got personal friends with a governor, and just to help us get some attention from the sheriff, not to go serve the evictions, because we got them processed, but just can't even get them served. They don't have the staff to just actually go out there and serve the evictions. These people have been living for free. So it's been tough, right? So not only do you have the aggregated steps of everything I said before, but now you have a temporary financial disaster. So that's what reserves are for. That's exactly what we were talking about before. Who would have saw this coming? This is equivalent to a property burning down, a building burning down, right? You need to have those reserves. Now, we're writing this out and we're at the tail end of this, and evictions are getting back online, and we're playing catch up, and we're turning over the tenant demographic, but that slowed us down. Timelines are what are tough. And in a time when interest rates are constantly rising, when valuations are shifting, you need to do everything you can to stay on timeline. You need to renovate. But the challenge is, if you can't get people out, you can't renovate, which means you can't increase your income. Material supplies, COVID also hit that, right? There's a global supply chain challenge coming out of COVID. With the evictions backlog, that delays our ability to raise rents, which delays our ability to cover all the other rising costs we're seeing. So this is a very different compounding effect, and it's why you probably hear of certain operators that weren't, say, as strong, having some challenges. And it's important to know this macroeconomic type of perspective to fully appreciate why things would be tough. Now, meanwhile, if you had invested in the stock market, you would have lost your principal, right? It's been very much a wild ride. In these multifamily deals that we're in, when structured properly in the ways that I'm suggesting, your principal is still secure. What it's doing, it's affecting your cash flow, right? And it's slowing us down. So there's a perspective to look at here. But with all that said, we've kind of gone through how I approached before 2008 super aggressively, and 2008, 9, how I was over leveraged with balloon payments, and I didn't have cash flowing assets, and I didn't have reserves, and I bought things in my own name, and they cross collateralized with all my own personal assets. Talked about how post that I started being a DIY investor, buying single family, moonlighting, struggling. Then we talked about how I traded up to larger commercial assets, right, that are cross collateralized, that aren't cross collateralized, that are strong cash flowing assets that are just owned by distressed owners, right? Or need a sense of that we can get at a discount because they hadn't fortified it. And then we bought these in a recession resilient way by looking back and saying, hey, here's all the ways that people are distressed today and before. Let's make sure that we build these properly. And now we're in the situation, which we could predict a lot of what's happening based on what's past, but no, there's all these new things going on. Compounding inflation, compounding interest rate growth, compounding COVID delinquencies, compounding with taxes growth. So all the, how do you do deals today? And that's where we kind of get into the situation where Warren Buffett talks. And this is where it's kind of a little bit near and dear to my heart, because in 2009 and 10, I wasn't able to purchase a bunch of properties at a crazy good deals when you could do that. And because I was getting raked over the coals and struggling that whole time. It was very much a humbling time for me. But today is that time again. Today is that time again because, you know, Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Because we are cognizant and aware of all these macroeconomic factors, and we have been through recessions, we can see very clearly the opportunity. And that's the upside of downturns, recession resilient investing strategies. So how do we do it differently today? And I don't see a bunch of Q&A or chats out there. I mean, are you guys just eating away? What's going on here? I mean, feel free to pop in and ask questions. But investing differently now, it's time to make your money on the buy. And that is really at the heart of buying in a downturn, is you have the opportunity that's once in several decades to not just have to hunt and hunt and hunt for these off-market deals, but for you to be able to find a plethora of deal flow where people, the assets are strong. Like I've told you before, the assets are very strong and you see the examples, but there's something wrong with the ownership, or they economically didn't fortify it correctly. It's a great performing asset, but you can make your return on the buy. And that's right for any kind of industry, especially in recessions. So we are not looking at decades past at value add, which means we're not looking necessarily to make our return or requiring our return to be made by buying something and slowly improving it over years. Right now, we have the luxury of buying something and making that return immediately. And there's so much deal flow from recession affected operators that we can continue to swoop these up. And the goal being, well, let's not do the long-term hold. Let's not try and buy something and outpace growing interest rates and try and outpace that reduction in valuations and try and execute improvements when construction costs are going up. Delays are increasing. Labor's scarce because there's a great resignation that happened. Labor's costing more. And let's not try and play this game while the tide is receding to try and fix that tide through a value add process. I think, and this is a nod to the surfers out there on Waikiki Beach, there's always about 100 surfers trying to ride one single wave in. But while the tide is lowering right now in real estate, there's a reset happening. There's an opportunity to ride waves in. Those waves that come in don't require a lot of work, a little bit of paddle. But once you get on that wave, it'll ride you, as opposed to the value add, which is a struggle the entire way through in a fight right now. And so we don't believe the value add traditional strategy is the right way to strike out today on a deal. I think it was very well serving up until now. But right now, we can go direct to owners. We can, just like we had in the past, and I showed you some examples, we can get great discounts, or we can buy great assets that we know before our earnest money goes hard that we can produce a return. And then instead of doing the long-term hold and kind of hoping and wondering, capture that value, do a trade into the next asset, hold for a very short amount of time. And then that next asset, make your return on the buy, and trade to the next, and trade to the next, and trade to the next. And so these are distressed operators, not distressed assets. I couldn't 2 years ago say that this was the best strategy. Why? Because they were very difficult to find. Now they're still difficult to find, but we're very good at it. But the systems that we used to find these deals before are finding huge amounts of them now. So it's one of those very rare times. The faster you move right now, to the more you can buy at this basis, the more wealthy you will be. It was the people that bought at the right time in 2009 and 10, performing assets at better basis in 2000, that are billionaires today. So it's about volume. Short-term holds by trading forward is how we believe it's in. We've got a couple examples. So again, we're buying for cash flow. So we're not looking to buy destabilized or assets that need a ton of work. You don't have to right now. By doing by moving quickly, and just like always, I think I told you about one of the examples of one of our assets that we had to jump in and we had to pick up with a family office because we had to close quickly in order to get the basis. And then we backfilled it with a raise. We were able to sell it in 10 months for like 10 million profit as a Canopy Creek deal, which we did a 1031 exchange into another asset in Houston after that. Similar to that, you want to operate like that in today's market. Why? Because these investments are a little bit like whack-a-mole. When you see them, you got to move, you got to pounce quickly. And that's why we believe it's most important to be well capitalized. And it's not, you've probably heard it before, but cash is king, right? In a buyer's market. So being well capitalized, and that's why we're using a fund to be able to pounce on those whack-a-moles and be able to know once we get in there that we can move quickly, we can pull those assets, and then we can backfill it with very low leverage debt. So about 50% loan to value, which allows us to buy a second asset. And we can trade forward the first one to a third asset. Now you've turned 1 into 2. Consider that same in 2 into 4, and then 4 into 8. And that compounds, right? Shorter term holds and compounding returns gives you that diversification. It gives you the ability to take advantage of as many of these buys as possible. And so we don't believe the best strategy right now is to tell somebody, hey, invest in this building. We're going to hold it for 3 to 5, 5 to 7 years. And then when we refi, we're going to distribute that. And then when you sell it, we're going to distribute that. That's a disservice, I think, to the investors right now, because they have so much buying power with their capital. The best recessionary strategy today is to efficiently use their capital as much as possible. And that's why I think the best recessionary strategy is to get the capital into a fund and then immediately put it to work, pull it out, instead of distributing it, immediately buy another one, and then pull it out, immediately buy another one, and then trade those forward with exchanges and more, and then continuously circulate this for as long as we can. We know until well into 2025, we're going to have some opportunities, but we don't know how long that's going to last. The thing about the United States is it's very good at getting itself out of recessions. It's the world's strongest economy for a reason, and the government will come up with products, just as they did during COVID and in years past, that allow distressed owners of apartment buildings that house America, that allow them relief. They're not going to kick all the Americans out on the street. They rely on us to house Americans. They're going to provide vehicles for us to be able to do that. But while people are distressed and their loans are coming due, interest rates are going up, and they're struggling, we can then be the source of relief for them. As long as we're buying for cash flow, so that if there's a recession, we can ride it out, low enough leverage, break even occupancy. And through the diversification across asset types, locations, and scale, you can build within one portfolio a recession resilient investment strategy. So we use, and to find deals like this, use a combination of sort of the newer tech. I recommend people really invest in AI right now, because with AI and machine learning, it's so much easier. You can do in a matter of minutes what it would normally take analysts, weeks to do, to be able to filter, to find the right kind of investments, find the right kind of assets. Direct to owner outreach. Right now, you'll see in our track record that we've done a lot more. We've done more broker pocket listings than we have direct to owner. But the challenge with that in this recession is that if you're talking to a broker and you're an owner, then the broker's been whispering to you pricing over years. Hey, it's worth this, it's worth this. Well, now that broker has to pull you back down, has to talk you down the ladder. And so it's tougher right now, as brokers have to say, actually, it's no longer worth it. It's no longer worth it. It's a harder conversation. It's like this go-between between you, the buyer, and the seller, and this broker. That's the broker's trying to talk you up, and he's slowly not wanting to lose face with the owner. And so by getting rid of the broker, it could be much more efficient. And finding out owners that have not been whispered constantly by brokers about what their property is worth over the last 5 to 10 years, and you can go direct to the owner and just get it done. That's potentially the best strategy right now. And so during these recessions, my recommendation is lean into technology, because you got to move quickly and efficiently, go direct to owner, and get that acquisitions team mobilized. It's whack-a-mole. As soon as you see those opportunities, like I said, before we know our earnest money goes hard, we have confidence that we can pull our value, our capital out within about a year to 6 months to a year. Then don't wait 30 to 60 days to close that. Close it and move on. And so mobilize that acquisitions team to do that. This is an example of an asset, and we don't actually provide any. So this is with direct to owner acquisition, 72 unit apartment complex. The seller's spouse passed away, left the operations of this asset as well as 100 single family homes all on the remaining spouse, overwhelmed, needing to simplify. This property was dropped to a 45% occupancy just from the spouse being overwhelmed. Performing asset, distressed owner. And by the time we closed on this asset, it was worth more than, I believe this is the asset. We don't have the returns. It was worth more than we purchased it, to the point almost double. So we were able to almost get a 2x return just on the acquisition. And the simple lease up of this asset makes for a very short-term hold with a tremendous value to be had. This was a broker pocket listing, 208 units, 60% occupied. Seller ran out of funds, not just on this asset, but on another one. This is a distressed seller, distressed owner, not a distressed asset. They were distressed from economic woes they had elsewhere in their portfolio, and they wanted to liquidate this to save the other. So we were able to swoop in quickly, 60% occupied, 123 unit, Louisiana, similar, 50% occupied. Seller was getting old, wanted to retire, wanted to get out of management, and very light renovations needed, really nothing that would cause delays, but being able to capture that value on the buy. And here's a retail center. You're like, what? Well, if you're not worried about holding things for a very long time, and you're looking at making the return on the buy, and you're just going to offload it, then sure, why not? Because if you can get an incredible deal on a retail center, and you can get your capital out before your earnest money goes hard, and then you're just going to trade it forward, and it's in a good place, it's in a good area, why not, right? And a lot of these retail centers have very strong tenants, and oftentimes are triple net, so they're much easier to manage. And so there is some diversification we're looking at in retail centers. Owner was a doctor. Sound familiar? I mean, I was a single family owner, moonlighting it while doing high-tech automation and robotics for many years. And he had his wife that's inexperienced managing the property. Great location, and we were able to jump in there and buy it at a discount. I think we removed the returns because we're not supposed to show them in this. So That kind of gives you an example from, and we got about 10 minutes here for questions, gives you an example of the kind of ebbs and flows of the past downturns, considerations on how we were able to create a recession resilient portfolio in the past, and how we were and what we're seeing the macroeconomic indicators today, and how to pivot today in order to move forward. And if you're interested in learning, we'd be happy to. We've got passiveinvestingmastery.com/LFI. There's a 2D barcode. We do give away a free copy of my best-selling book. It's a hard copy. I tell my whole story. Phil Collins, lead guitarist of Def Leppard, is in there. Actual rock stars, NFL, NBA players. Really cool. I had a lot of fun working on that book. Persistence, pivots, and game changers, turning challenges into opportunities. I give it away because I think it's inspiring and a lot of cool stuff. So I'm happy to ship that out if you'd like to have a chat. There's a form there. Make sure you put left field in the promo code for that. And on that page, we also have an opt-in for our recessionary acquisitions fund. It's a wait list. If you're interested, you can pop in there. And when we have availability, it's fairly fair. We do have a wait list line for that.
Great stuff, Patrick. Thank you so much for coming on. This is the quality stuff we look for in a lunch and learn. So we thank you for delivering. We do have some questions that popped up. I'm happy to read them off, or if you want to go through them, however you want to approach these.
Let's see. We kind of prepayment penalties, yield maintenance. How much would you have to pay on a theoretical early sale? That is there is really no. We have like 26 properties, and it's all across the board. The prepayment penalties, the yield maintenance is oftentimes a step down. It could be as much as 1%, 2%, 3% of the value of the loan. Oftentimes, it kind of ranges on those. And I think what you're going to see more so moving forward on those, because if there's any kind of fixed rate debt that has existed previous to a year and a half ago, nobody's going to want to do an early prepayment because or payoff, because they're all going to want to assume those, because those interest rates are so advantageous. They cannot replace it with better debt today. So you're pretty much going to be stuck with, or you're going to actually have an advantage going to market and offering that as a loan assumption. We've done a lot of that over the years. How tough is it to implement the value add aspects of a deal with rising material costs and labor issues, and how do you see these playing out? So over the last year or two, what we used to be able to do for like $4,000 to $6,000 now costs closer to $10,000, and we're actually plugging in sometimes $12,000. So I would say that's almost a triple in the material costs. Weird things are going on. Like all of a sudden, stainless steel appliances are the same amount as white appliances. I mean, there's just supply chain issues that have just driven costs of things that are traditionally lower cost. And so we just dropped stainless steel appliances into a property. We would never have done that. We've done black in the past, just because it was the same price. This is, do you think you can find seller directly on large multifamily? Would these be relatively sophisticated investors that will be using brokers to sell? So all those multifamily, like that 100, unit size, and also on that 300 unit that was in Jacksonville that we had done before, all those were different people in the industry, but we had access directly to the owner. And sometimes what will happen is we'll get in contact with the owner, and then we need a broker to execute it. But we were able to get in there direct to the owner and have a conversation. And then, especially on larger assets, we had assistance from a broker in order to close on it. But the expectation setting and that gap that we see with brokers going just directly to brokers right now, it's much easier to walk down the owner and to come into a soft handshake and an agreement with the owner if you get to the owner first than it is to just go directly to the broker, because owners just, if they've been talking to a broker actively, they just haven't readjusted their expectations of their property. And yes, can you find them at scale? Yeah, absolutely. Right now, there's a lot of distressed owners out there, and they're willing to talk. They're in a lot of trouble, and they're happy to talk to people that can be the source of relief to them. And they want to do this quietly. So again, people don't like, in a lot of these cases, people don't like big, flashy sale events, because if they're just trying to return their investors' capital and it didn't meet projections, sometimes they just want to exit quietly. Do you find the best deals nowadays are the ones with low interest rate assumed debt? Do any deals where you, pretty much, if you're looking at the old school value add strategy, I'm calling it the old school because prior to, a year and a half ago, the best deals that I've seen that are value add deals are assuming long-term fixed interest rate debt. 1, 2, 3, 3.5% debt. I've seen quite a few deals where they're putting up like 50% loan to value and they're assuming long-term debt. And so there is some hope, I think, in the strategies that can do that. All the cash flow is sucked out if you try and lock in new debt, because those interest rates are extremely high, and it's very difficult to cash flow. So that's where I've seen those be successful. For the deals we're doing, most of the time debt is the problem, and we are restructuring. We are introducing new debt, but oftentimes debt plays a role, and the financial engineering, the financial foundation of that property was not put on stable ground, and so we come in and do a cash or with funds raised within the fund, we'll do an acquisition. Do any deals where you don't have assumable loans, the assumable debt pencil? Well, there are HUD loans that I've seen individuals put together. HUD loans, they're like 40-year loans, and there is still some ability to make those work out, but they take like a year and a half to close on. So you have no idea really where you're going to end up. And I think what's unfortunate about that is now's the time to buy a bunch of really great deals. New debt, does new debt pencil? Not like it did before. What we're seeing is negative interest, negative cash flow for 6 months to a year, and people trying to raise reserves to pay out of reserves cash flow for 6 months to a year. So it's very, very difficult. And I don't want to go too far into it, but as long as the interest rates and the cap rates are upside down like they are today, we're going to have a harder time. B. DeWick, wow, you're on here. Good to see you, man. How feasible cash out refi at higher rates? At higher rates, well, it depends on all. It's very feasible if you're at 50% loan to value, and you got a solid, strong asset, and you're cash flowing. Fundamentals of the deal are strong, and like we're saying, we're buying great assets but troubled operators. And you're going in there at low leverage, yeah, people will loan on that all day long. So it just depends on the asset itself. Sorry if I missed it, but are you vertically integrated? If not, who handles property management and/or construction management? So it depends on the assets and the locations and what partners we have. I tend to be a proponent of partnering with regional, strong individuals that do vertically integrate. Most of my portfolio is vertically integrated. And honestly, I was kind of the proponent that third-party property management was better leading into COVID, because third-party private equity firms don't tend to be property management type people. And I can compare it a little bit to when I was an engineer working at the Toyota plant, which is now Tesla. There were these designers that would design a piece of the car, right? And then there were these product engineers that would take that one strip of windshield molding, do wind noise analysis, and get it perfect, get it from 90 to 95 to 99 to 99.999. They'd spend their entire career perfecting that one piece. Private equity, sponsors tend to be people that want to create the next car model. They want to create a piece. They want to create a deal. They don't tend to be that long-term process-oriented individual. In the property management world, you need that long-term process-oriented that'll take something created by somebody else and then perfect it over a long period of time. So prior to COVID, I actually believed that it was better to bring in those process people from outside because they don't get distracted by the ebbs and flows and the push to close new assets. And they're hyper focused on getting perfection. However, during COVID, the ability to go all the way and knock on those residents' doors and help them fill out the rental assistance applications, the ability to do that with the vertically integrated properties was far greater, and the visibility was far greater, and the turnover we had was far less. So the management, the vertically integrated management was far stronger. I do prefer that, but it depends on the location of the assets, the type of asset, if they've already had managers. So with 26 properties that we've acquired, there's not a one size fits all for that answer, but maybe hope that helps to answer your question a little bit, Kevin. James, how do you confidently underwrite value add costs? Do you use preferred vendors across multiple properties, or do you source locally? Again, so we're actually, if you saw the map, there's a pretty big range, and it does range. Right now, it's tougher nowadays to confidently underwrite value add. And I was just mentioning that, where we used to put 36, 4,000, we're, much higher. And do we source locally? It's a combination. When we were doing an asset recently, we were able to buy a container of quartz hard countertops for like $300 a countertop. And so being able to do that at scale across hundreds of units and have that shipped in from Vietnam, huge win, right? The challenge with supply chains is right now, it's what's available. We're playing a little bit of again, not one size fits all and pivoting on the value add side. But again, I think the strategy right now is more rapid acquisitions and less hoping on rent growth and appreciation through value add, and miss this opportunity to buy things right. Yeah, so do we invest in other assets, other multifamily? In fact, the Recessionary Acquisitions Fund, we're looking at triple net, retail, and multifamily. Again, we're holding for short periods of time. And we have diversified energy funds. We had two. We had one towards the end of last year and one at the beginning of this year. We have a debt product that we're investing into with a recessionary debt play, which instead of saying, hey, look, we'll just take the asset from you, here's the source of relief through an acquisition, we can say, hey, here's the source of relief through a shorter term debt product, which would be a 30, 60, 90, 120 day first position loan. And if you look back at the people that got really wealthy in 2009 and 10, the billionaires that were created are those people that got in the first position or bought that first position from the bank. And so if in fact people in those cases meet the debt requirements, then we get great return. If they're not able to turn the property over, then we get an asset that we know we can operate better, we believe, than them, and we got it at an incredible discount. So the recessionary debt side is another asset we're launching here right after this recessionary acquisitions that's almost subscribed already. We haven't really sent anything out. And then the other one is medical receivables. And we're going through the due diligence process on that right now. And if there's any industry that's very recession resilient, in fact, medical receivables actually went up during COVID. So that's another completely alternative, non-correlated investment. Doesn't rise and fall together with real estate or the stock market or energy. That helps to build that diversified 25 to 50% of your portfolio into alternative investments. And so that's what we're working on. Any more?
That's great. It's dry right now, and I know we're over time. I was going to throw one more at you from my own end. We've got a very diverse population in left field. We've had some really strong questions that get deeper into the weeds. You talked a lot about how this new environment, there's a pivot going on and maybe a new way of vetting deals, vetting sponsors, those kind of things. But I like to kind of bring it back to the newbie. And is there any advice, tips you may have for a newer investor? Because we have a lot of those in our population as well. In this time frame, especially as things are adjusting, it's complex enough being new in what had been going on the last 10 years. Now we're in this different environment. Maybe some tips or tricks to the newer investor of how to get started. It's one of the biggest questions we always get is, how do I get started? What do I need to do? Anything on that end of that spectrum of things versus what we've been dealing with the questions?
Active or passive?
Passive, the
Passive.
limited partner side. Yeah.
Well, I'll give you the same answer. I was speaking on economics in Chicago, and the answer I gave there was partner up. If I had any advice that I'd give to myself when I first started back in 2007, right before the recession, and I was going DIYing it myself, and I somehow cross collateralized, and I didn't even know what that was, and I was in a recourse loan, which I didn't know what that was, and I didn't have the experience. I was naive, and I went at it, and good for me for doing it early and losing it all, and coming out. It was painful, but coming out stronger. But even when I was DIYing it, 10 years later in single family, I still hadn't partnered up. My belief is that the best thing to do is to learn from those who've been down the road and failed and succeeded. And so the partners that I tend to resonate with are people that have seen failure and succeeded through it. And it's not dissimilar from a high-tech space. When venture capitalists look at CEOs to invest in, they want to see people who have not just succeeded their whole life, but have been through tough times and become out wiser. And and even if they've gone bankrupt 3 times, that actually, if there's good reasons for that, and they then are now seeing a strategy that will win based off of failures from the past, that doesn't deter venture capitalists. They want to see that how they acted and came out of that failure. And so with sponsors, when you partner up, find somebody who's been through it, who's had been humbled and is now the tortoise and can speak intelligently about what happened and how they're fortifying moving forward as a result.
Yeah, no, I think that's great. That's a great tip. Thank you for that. We did have one more question pop up in the Q&A. Since you think now is a good time to buy, is this at least in part because you think interest rates are going down from here?
No, they're not, Kevin. Actually, I think that they're going up, and this is the time to buy. And like I said, this isn't the time to buy and hold. This is the time to take this very rare opportunity to when interest rates are high, and I think that they've shown very clear signs that continue to go up, to buy distressed, to buy great assets from distressed operators, as not at all doesn't have anything to do with interest rates. We're not trying to catch a falling knife. And when we catch the knife, hold the knife, right? We're buying systematic assets. We're systematically underwriting assets that we can see we can capture our value when we buy it, and then we're trading it forward. Interest rates can keep going up, valuations can keep going up, and that's fine, because we know that when we go to acquire, even if we underwrite, and I don't know how the depths you want to go, but even at 100 basis point cap rate inflation a year, we're still projecting to make our return, which is normally 10 basis points or 15 or 20 basis points. So we're actually projecting a depreciating environment in our recessionary fund. That's all part of buying in a recession, right?
Yeah.
So you got to find deals that you'll still make your return, even if by buying right, even if the market continues to soften, which is exactly what any responsible operator will be projecting, not hoping, but projecting in the returns of the market will continue to soften.
No, that's great. Again, Patrick, thank you for your time. I'll cut things off since we're about 12 minutes over anyway, but your contact information is here. If anybody's interested in more dialogue, please reach out. But thank you for coming on. Really good stuff today. We appreciate it.
Yeah, feel free to grab my book. I think it's investonmainstreet.com/book, and set up a call. Happy to chat with anybody, get you pointed in the right direction.
Great. Very good. Thank you. And thank you for everybody that tuned in. We'll talk to you later.